Hello and welcome to chapter 25 of Business Law 160 for CSI. Okay, so this chapter focuses on transfer and holder in due course. What I'm going to do is I'm going to go through my notes. I'm going to go through the textbook. But one of the first things I want to do is go over some vocabulary I'm going to be using. So a holder in due course. What is a holder in due course? Simply put, it's a person that is holding a negotiable instrument and has no reason to doubt its validity. We're going to get into detail about that a little bit later, and you'll see that with the cases we go through. One of the other things I want to tell you to make sure, this is all in your textbook, part of your reading for today, so this should be not completely foreign to you. When we talk about negotiation, when we talk about negotiation with respect to holders in due course or negotiating an instrument, it's simply the the transfer of it. So negotiation, equate that in your head with a transfer of an item, of a check, let's say. And when we talk about it's just simply the transfer. Just keep it simple. Negotiation is the transfer. And a lot of times a check is the most simplest way to envision these items that are being transferred back and forth. And how do you do that? You can do that by writing out a check to somebody else, by assigning it. Now you know what an assignment is from our previous discussions. And an assignment, all you need is intent, right? So if I intend to give you a check that was actually made out for me, that makes it valid. Okay, so those are some of the terminology that when you first turn into chapter 25, those are some of the things that you see. You'll see here, negotiation. Okay, so one of the fun things about this chapter is the impostor rule. And you see the impostor rule depending on which version of the book that you have. The textbook, it's on page 451. I believe this is the 13th edition. So the impostor rule is kind of fun. Let's say I meet you, you're a regular average person, you be you, and you don't know who I am. And I meet you at some kind of function. And let's say a local community affair. You don't know me and I don't know you, but we start chatting. And I tell you that my name is Joanna Smith. And you happen to recognize that name because Joanna Smith is a prominent person in the community. But you don't know what she looks like. You've never met her before. You've never spoken to her. But I tell you my name is Joanna Smith, but my name is really Irini Bekhit. So we start talking, we exchange contact information, and I tell you that I embellish a little bit more about what Joanna Smith does. I tell you about the community affairs and the community involvement that I've done, and I suggest that you invest with me, or you give me a loan of $10,000 or invest in my company. And you get excited because nobody's ever paid attention to you in life. And so you want to deal with this person who's kind of a social butterfly, this Joanna Smith. So you make out a check from your name, your account, to Joanna Smith. So I, as Joanna Smith, can now invest this for you. So I take your check. Now don't forget, I'm not really Joanna Smith. I'm Irini Bekhit. I take the check that's made out to Joanna Smith. Now, I'm not really Joanna Smith. So what I do on the back of that check is I sign my name as Joanna Smith. And then I go to a check cashing place and I get it. And I write my name, Irini Bekhit, underneath. So now we have the names of Joanna Smith, which I forged, and I write Irini Bekhit. And I don't know if you all are familiar with checks. If a check is written in somebody's name, if they sign off the back of it, and they want to give it to a third party, they can just put that person's name on the back, signed, so it's as if two people consented to that, and then they get the check and they can deposit it. So now I take that check that was made out to Joanna Smith, and I go to a bank or a check cashing place, and I get it cashed. To me, I forged the signature of Joanna Smith, but now as Irini Bekhit, now I'm getting the cash. And what the courts have found, or rulings have found, generally speaking, when we talk about this imposter rule, is the bank is not at fault for cashing out the money or cashing out that check because it was legitimately signed. There's no reason to doubt it or anything like that. The bank becomes a holder in due course. There's no reason to doubt the validity of this check. And what happens is, now, you know who is out of luck, who loses the money, they don't get it back? You. Because what the imposter rule says is that you should have known better. You should have done your background check. You should have looked up to see who Joanna Smith really was before you gave her your money. So that's what the imposter rule is. Again, it deals with checks. And one of the reasons I don't spend that much time on these chapters is because checks are not used as frequently as they used to be 10 years ago, 15 years ago, 20 years ago. And now a lot of people are using online payments, so there is a little less check fraud because people are doing a lot of payment through Venmo, through Zelle, direct payment from one bank to another. So these things I don't feel are as relevant, but since it's in the textbook, I want to make sure that you know it, and if you're watching and you're paying attention. So one of the scams that are very similar to the imposter rule that I always like to bring up, I don't think it's as common now, but let's say 5 years ago, 10 years ago, I was actually seeing a lot of it. If you've ever gotten an email or a phone call from somebody who claims to want to purchase an item that you put for sale on Craigslist, let's say. You put up an item, let's say you were selling your car, let's say you were selling some furniture in your house, you were selling something of value, a few $1,000s. You post it on Craigslist or one of those media platforms, and somebody contacts you saying that they're interested in purchasing it. And okay, you start emailing back and forth, and they tell you they're not going to be able to come and see it, but what they'll do is they will send you a cashier's check for more money than you requested, and you just send them the balance. They don't have time to come in. They'll send movers to come in and take a look at the furniture or the car, and they'll pick it up. That is a scam. Why? Because what happens is they send you this cashier's check or this check, personalized check. You deposit it. You send them the balance, right? You think they're being kind, but you send them the balance. The money you're sending, that you're wiring to them or doing as a cashier's check, is legitimate money. So now they get this legitimate money. By the time you and your bank find out that the check they gave you does not have enough funds there, it's too late. They've already taken your money. And you may be sitting there thinking, well, that's not really likely to happen. I personally know people who were scammed by this. Sometimes people think that it's a good deal, let me jump on it. If it's a deal that's too good to be true, it probably is. So don't fall for these things. Sometimes, I've gotten emails about to my work account about somebody trying to hire so-and-so, and they're willing to pay this much money for a consultation with a lawyer, and they need help with the international blah blah blah. They'll send me a check, blah, blah, and I send them a check. No, don't send money to anybody you don't know who they are, because what's going to end up happening is, even though there is fraud, even though there's an underlying criminal charge, the civil action of it, and the bank who's making that money exchange, they're not going to be liable for any wrongdoing because they have no reason to doubt the problems of those money or that there's a fraudulent transaction. They're just doing their job. They get a check, they're going to cash it, and that's it. Only if a check is maybe up to a certain amount, or more than, let's say, $9,999, then it's going to be looked into. So you just want to be careful when it's time to give money out or receive money out. So that's the imposter rule. One of the cases I want to go over with you is the Hyatt Corporation versus Palm Beach National. This is also an interesting case. It's not, I don't think I listed it on your syllabus, but it is in the chapter, and I'm going to go over it briefly. It was a pretty quick case. And so this case is, you have three entities that are getting into business with one another. Hyatt Corporation, who hired Skyscraper Building, and J&D Financial Corp. And what was happening is Hyatt was sending out checks to both Skyscraper and J&D. So they had both their names on it. And so they were working together or whatnot. And most of the checks that were being sent to both Skyscraper and J&D were being signed by both, endorsed by both. Endorse, ENDORSE. That's not the spelling, it's with an I. So you got to make sure that you're spelling it correctly. That's the endorsement. It's just the simple signature. The endorsement itself was being done by, let me just see here. It was only being endorsed by one of the parties. So the checks were being made out to Skyscraper and J&D, and then what was happening is only one of the parties was signing it on the back, endorsing it on the back, and then cashing it. So then the other payee, the individual, the company that was supposed to also be sharing the profits, were saying, "Hey, bank, bad bank, you cashed these checks when you weren't supposed to." So they put the bank on the hook, but it turned out that the bank was correct. When you make out a check to two parties, the default rule is that either one of them can endorse and cash it. So let's say I write a check out to my friend Maria X, and I put down her husband's name also. It was a wedding gift. Okay, so Maria and so-and-so, Maria and John Smith. Maria Smith and John Smith. So the check has both their names. Either one can sign the back of it and cash it. Unless there's specific instructions that both people's names must sign together, then the bank doesn't have to have those two signatures in order to cash out that check. So what this case says is the default rule is when you're sending out a check, writing out a check, and it has two payees' names on it, either one can sign the back of it, and actually get that money. So that is your Hyatt Corporation versus Palm Beach National Bank. Some stuff I'm not going to go over because it's not important. Again, endorsement, INDORSEMENT, endorsement, not the endorsement, ENDO. So don't get it confused. The one with the I, it's just basically a signature. That's all it is. When you're signing a negotiable instrument, like a check, that's the most common form of negotiable instruments. It just means you're signing it. So if I endorse a negotiable instrument, if I say that, all that means is I'm signing a check. Okay? Blank endorsement. It has a little something about that in your book. Don't give out blank checks to people and let them fill it in. Never a good idea, because a check is considered like cash, right? So you don't want to just give it out and it be in the wrong hands, then they can fill out. If it gets into the wrong hands, then whoever receives it can now just put their name on it. They can go get it cashed, and then good luck for you returning it. Even if you put a stop on your bank to try not to have that thing cashed out, if it was already, if a bad person gets this check and then they go to a check cashing place and they cash it out, you're just creating problems for no reason. So that's just good practice. If you do have to write checks, which, like I said a little while ago, we're kind of shying away from that. A lot of these things are like electronic payments now. Make sure that you follow the rules. And I think I had mentioned it in one of the other lectures, the chapter 24 lecture. Whenever you are writing out a check, in that memo field, write exactly what that's for. If you are giving your friend loaning money, which I'm 100% against, don't loan people money at all. Never ends well. What you want to do is you want to write down specifically that that's a loan. Make it, if you're saying that a check going to two people must be endorsed, put instructions on there, or let the bank know, or make it in writing, of course. Make the authority know that both people have to sign off in order for it to be a valid document. Okay, another case. Interesting case. I don't know if I agree with it. It's also not in your syllabus, but I'm going to tell you a little bit about it anyway. It's for your pure knowledge, because I know how much you all want to learn. State of Qatar versus First American Bank of Virginia. So there was this guy. His name was Basim Salous. and he worked for his employer was the state of Qatar, so he was an employee by then. So what he was doing was he was making fake invoices, and then they would pay the fake invoices, and he would take the payments, and he would put them in his account, deposit in his account, but like on the checks it would say deposit only. So like the checks that he got from his employer only had the words for deposit only, and he would just write his name, so it was made out to him. It was a whole big scheme. And so what happened was, when the state of Qatar found out about this, they sued the bank for conversion. And what the court said was, well, when you have a specific direction, like for deposit only, it was then the bank's obligation not to just deposit it in somebody else's account. The bank's argument was, well, it said for deposit, we deposited that money in Basim's account. The court found that the interpretation of the words for deposit only means it can only be deposited in the account holder's account only, not in anybody's account, because that would defeat the purpose of having the words for deposit only. So those checks that are used for deposit only are meant to be deposited in the owner's account only, not anybody else. So that was just kind of like a fun fact, if you will. I'm going through the textbook here. I already went over that. Okay. Good faith. Good faith is a concept which comes up not just in this chapter. Good faith is a concept that comes up in contractual negotiations all the time, and especially in civil litigation. And good faith is the concept that you are dealing in an honest way with the person in front of you, that you're not trying to swindle anybody, you're not lying about facts, you're not withholding information. You are acting in an honest and professional manner. So that's the concept of good faith. So a lot of commercial cases or contractual cases, sometimes you see the issue of good faith being discussed by the court, because it goes to the mental status of that person at that time, the person that's considered maybe doing wrongdoing. Did they act in good faith, or was there a mistake in good faith? Because that could limit the liability on a particular person. The next case I want to go over with you, which is on your syllabus, any kind checks cash versus Talcott. This is kind of a sad case, because again, it deals with somebody being swindled who is an elderly person, and I hate those types of cases because it's not right. So the case takes place in the mid-1990s, and there's a gentleman by the name of DJ Rivera who claims to be a financial advisor, and he convinces this 93-year-old man by the name of Talcott to invest $75,000 with him. So he invests the money in 1990. In 1999, there's still like no return on that money. So that $75,000 is still $75,000. There's no return. And somehow it's not clear though. A man by the name of Salvatore Guarino, who is a cohort of Rivera, they kind of come up with like this scheme. So Rivera calls the client Talcott and tells him, hey, send me a check for $10,000. That way we can get you your with his travel expenses, and we're gonna go get you the interest on your money, and then we're gonna give that back to you. So it's a little shaky. I mean, the story doesn't make sense. So Talcott FedExes this $10,000 check to this guy Guarino, who's supposed to be going and getting the money for Talcott. After Talcott writes out a check for $10,000, and he FedExes it to Guarino. Then Rivera calls up Talcott, the older man, again. He says, you know what? We did the numbers. It's not actually going to cost $10,000 for the travel arrangement. It's only going to cost $5,700. So write out a check for $5,700 and then send that also to Guarino. That's all he needs for the travel expenses, so you can go get your money. So Talcott calls the bank and he puts a stop on the $10,000. He writes out a check for the $5,700, and he also made it to Guarino. Now, when Guarino first received the $10,000 check, he went. Now, the check was made out to him because Rivera told Talcott, the old man, make out a check to Guarino because he needs it to do this travel stuff so you can go get your money. So Rivera had a check that's made out to him. It was FedExed to him. He goes to a bank and he wants to cash that check for himself. He shows them ID, it's his name, FedEx to him, and because it's $10,000, it needs approval. A supervisor has to approve it. So the supervisor says that when he looked at the FedEx, the supervisor said he put a lot of stock on the fact that there was a FedEx envelope which was mailed directly to him. So the supervisor said, well, it must mean that Talcott, the old man, intended to send this particular check to this particular individual. They tried to get Talcott on the phone to verify the $10,000 transaction, but they were not able to do so. But he relied on the FedEx envelope. He cashed out the $10,000 minus a 5% fee for the bank. So Guarino takes the money, goes, catches it out. No discussion or anything about now that stop on that $10,000, right? So now Guarino gets that $5,700. He goes back to the same bank where his account is, and he sees somebody else, and he wants to get that cash. So the teller at that time looks into the person's account and sees there was a $10,000 check that was authorized by a supervisor. He calls him up, and the supervisor's like, hey, you know what, there was a $10,000 check that was just cashed, as you see. Call up Talcott. So the teller calls Talcott, the older gentleman, and no answer at first. He calls him up again, and he says, we have this gentleman. He's here to authorize this $5,700. Do you authorize us to cash it out to him? And the gentleman, Talcott, says, yes, I authorize it. No discussion at all of the $10,000 that was already cashed. So they give him the $5,700 minus a 3% fee for the bank. So now Rivera comes clean, I suppose, and he tells Talcott, hey, this guy's a swindler, Guarino. There's a problem here. You're not going to get the money, and we need to... He's actually a cheat and a thief, and we got to try to get your money back. So they ended up filing a lawsuit against the bank, Any Kind Checks Cash, which is the institution that cashed out these checks. And what the court found was that they found in favor of Any Kind check for the $5,700, meaning they did what they needed to do correctly. They called, they authorized that check, but they found for Talcott on a $10,000 transaction. Why? Because it smelled funny, and they should have looked to do more than they actually did. So the financial institution claimed that they were a holder in due course, that they had no reason to doubt that there was any fraud or any wrongdoing with either of these checks. But the court said you had a $10,000 check. You already had a policy in place that anything more than $2,000 you were supposed to check and get verified. When they called Talcott on that $10,000 transaction, they never got him on the phone. They just used this envelope, a FedEx envelope, to rely on that, and that wasn't good enough. And when you're dealing with that much money, they should have taken the extra step and make sure they speak to him before they cashed it. Okay, so that's Any Kind Checks Cashed versus Talcott. Okay. Let me see here. Okay, continuing with chapter 25. So notice, is there a reason to question the validity of checks or negotiable instruments that are presented to you? If there is no reason to suspect anything, then you cannot be held responsible if there was fraud or undue influence to get that check. Think about it and separate it. If you have fraud that induced somebody to write a check, the fraud itself, the action itself, there's a problem with it. The actual check or the negotiability of it, getting that cashed by a third party, there's no problem with that. That is a valid transaction. It's the actions leading up to getting that item cashed or written in the first place that's the problem. So when we talk about lack of notice, or if there's no reason to question the authenticity of an item, then that would be a defense a bank or financial institution would use. I had no reason to doubt it. They did what they needed to do, so therefore I'm a holder in due course. I can cash my checks. I can they gave us proper ID, or ID that checked out, so therefore I should not be penalized or subjected to pay any fines or penalties on a particular item. There's one other thing in this chapter that I want you to know. Yeah, this case of Watson Coatings Inc. versus the American Express Travel Related Services. And that is an interesting case. I like this case a lot. And I'll tell you why. So it's about really just paying attention in life and always being aware of what's going on and also not trusting anyone. So the Watson Coatings Company had this employee. Her name was Bekhit. And she worked she was an accountant, I believe, right? The accountant, then a company controller, and then a company treasurer. So she worked for this company for a very long time. It was about a decade. And over that decade, she had actually, let me just see here. Okay, she wrote between 45 and 47 fraudulent checks totaling $745,000. Now, what I mean by fraudulent, she didn't like forge checks or anything, but she would have her company essentially pay for the lifestyle she and her husband had. So she had an American Express card, and the company, Watson Company, also had an American Express card. So when she would get her bills, like her personal bills for vacation, for shopping, or whatever, she would just use the company's account to pay for that, to the tune of $745,000. So when the company found out that this was going on, they sued American Express. And they sued American Express because they cashed the checks that were being sent to them from Watson, and they should not have. What the Watson Company was saying, hey, American Express, you should have known better. You should not have been taking the money that we were sending you to pay for her stuff. What American Express said, which the court sided with, was we had no reason to doubt the checks, the payment that was coming to us. There was no notice for us of any kind that that she was not an authorized signatory, that these were not authorized by Watson. Like, what American Express said was, we send you statements with an amount that's due. You pay us that amount. Like, if the problem's on you. And what the court said was, American Express is right. You, Watson Company, you need to be aware of what your employees are doing. You can't hold this company responsible for taking payment. They had bills and statements outstanding. They were paid for. Therefore, there's no notice. They had no idea to suspect that there was any wrongdoing, and the burden is actually on you to keep tab on your employees, and your responsibility to make sure that the people that you're hiring or employing, or the checks that are going out of your business, are actually legitimate business expenses. And I think that's all I want you to know for this. Okay, really quickly, defenses to holders in due course. You can always claim infancy, so the person that wrote or authorized the check was an infant under the age of 18, it shouldn't have been accepted. Incapacity, they did not have the mental capacity to do so. These things you've heard before, right, in contractual settings and other settings that we've talked about. Fraud in the execution, it wasn't executed properly. And an unauthorized signature or fraudulent alteration. So those are some of the defenses that are used when they're trying to now say that money shouldn't have been cashed, or that check shouldn't have been cashed by that particular banking or financial institution. Okay, so that concludes everything I want you to know about chapter 25.